people who think they have a lot of money think that they have more wisdom, or they think they can predict the future, which is like completely uncorrelated, right? Predicting the future has nothing to do with riches or, intellect. It's just something that human beings are really bad at. And so I think humility is the first thing I look at when I look at an investor.
Nice.
Good investors have humility. Right?
Nice.
If you don't have that, you cannot be a good investor.
Nice. I'm sensing a lot of humility here.
Humility because I failed so many times. I lost a lot of money in my investments. So I had to be humble because, I didn't, it was a long winding road to, where I got to.
ESG investing is catching fire. Apparently, there is data showing that millennials are increasingly concerned about ESG. We care about companies beyond just making money. We want to know, where are they putting their profits? How well are they taking care of their crew? And what kind of environmental impacts does the business has? And how are they rectifying them? All that has spilled over into our investments, but the question is still, can ESG investing actually be more profitable than traditional broad-based market index? Or is it just another fad? Welcome to another Chills with TFC session. In this series, we hope to bring on interesting, relevant people to help us learn better from various perspectives. Life is not always about learning from people that you already agree with. Perspectives shape a rounder thinker. So in our pursuit of life we love while managing our finances well, our guest for today has taken a different route from his team to champion for ESG investing. From what I've gathered, not everyone on his crew actually agrees with his direction, but this guy is going to prove it to them, and we had to have him on. You are not unfamiliar with the company. They are pretty synonymous with CPF investing, but they want to go further. So I'm happy to introduce you to Samuel Reed from Endow Us.
So what is your core investment ideologies now then?
Look, I think everybody is different. That's the first thing.
For sure,
right?
for sure.
Because I have a lot of experience investing. How I invest and what my philosophy would be very different from, the average uncle or auntie in Singapore who are working and have never really read a finance book or invested before, but are thinking about investing for the first time. Those guys will be very different from a white-collar professional who's dabbled in stocks, doing a little bit of Bitcoin, reading these financial blogs, and he's much more educated. So he will be a different investor. And the other thing is I really believe that everybody's personal financial circumstances are different. Their goals in life are different. Why they're investing is different. So, having this blanket statement of this is how you should invest is something that I'm very uncomfortable with sharing. So I can share how I invest. I put all my money in Endow Us and I just manage it outside. On that platform, that amazing platform.
I am my first biggest client, right? Like,
I buy what I sell,
I love that. But I get what you're saying.
But the reason is because I just don't have time these days. When you're building a business, I just don't have enough time. It's just, if I was a full-time professional investor, I would do it very differently.
I know.
I would, pick some stocks that I really like.
I know.
I would dabble in some other new, investment ideas. But right now, I just don't have time.
I totally get
that. So I
that.
just go passive. I have a core asset allocation. We just launched ESG portfolios, so I allocated immediately to the ESG portfolios because I found these funds. It's the best that I could find, and we built a portfolio around it. So I was like, okay, I got to do this because this is something that I really believe in. So I'll go into this and allocate like maybe 20, 30% of my portfolio into that. And then, if there's like really good like sectoral funds or thematic funds, then I would allocate to that. But I've kind of given up on single stocks for a while because I just don't have the time to control it or keep track of it. And I don't want to be like checking the stock price every day of every moment, right? Seeing where it is.
Totally get what you mean.
So that's what I do. I have a little bit of exposure to crypto, but not really active there.
Just having some fun and
just
treating it like an option for the future.
Actually, that's what you should do. Me is a very different story. I had a friend that I was just helping out and investing in his company, and that company did some ICO token issuances, and I got some for free. So that's why I have exposure, and it's gone up like 100x. But I have really, really tiny exposure, so it just doesn't mean much.
Nice, that's cool.
But I do follow the space. I think it's really fun and exciting, but I wouldn't allocate a huge piece of my assets in there.
Yeah. I mean, there's so much innovation going on and all the interesting stuff. So
That's right.
It's good stuff. That will be for another day, right?
That's for another day. We'll do a separate session on that one. I got a lot to speak on those things.
A lot of those stuff.
But exciting and fun, and important as well, and it has long-lasting implications. So everybody should keep track of it at least.
Yeah, a lot of
even if they're not invested.
We're gonna be launching a podcast just for that. So yeah.
Oh really?
Yeah,
that's super exciting.
We're gonna do a whole thing just for that. Like, it's gonna.
Okay.
We may sell NFT in every episode.
Nice.
You know? It's like so just like vibing with that. You know, just kind of playing around and see what works. Right? It's just kind of experimenting the whole thing, and you never know, right?
Okay.
So
no, that's wonderful.
Stay tuned, guys.
Right? This NFT for me is good. I mean, this podcast, this episode, hopefully is the best-selling NFT, highest value.
The open market bit, right? So
small clips of it, break it out, sell more.
All the good juices.
Limited edition.
Nice, good stuff. And you talk about ESG investing, right? So I think ESG is like multiple things put together, right? So for all of our audience, like what is ESG then?
Man, I don't know these days. There's so many definitions of ESG.
I know, right?
But there's sustainable investing, which is the broad umbrella. Within that, ESG is another broad classification. ESG stands for environment, social, governance, right? So those are the three big pillars of, responsible or sustainable investing. Within that, you have socially responsible investing, which is values driven. So if you're religious or, you don't want these sin stocks, you don't believe in violence, you take those out.
Right? So no weapons, no alcohol, none of those things.
Or porn or alcohol or,
Wait, you can buy porn stocks?
There are apparently.
Okay,
apparently. I see it mentioned quite a lot. Yeah. Okay. Well, I mean, I don't know personally.
I don't know. But okay, next time.
But I hear there are some porn exposure around.
Wow. Okay.
Yeah, but porn, pork, all these things. Yeah. So you remove those, and that's a values-driven, negative screening, investment kind of.
So you remove all those
philosophy.
things because it's not aligned with your beliefs.
Precisely.
Okay.
So that's actually the lowest, easiest way to do things. A lot of indexes or passive, ESG strategies and ETFs use this strategy, but it's the most basic form, and it's actually being proven not to be that effective in driving change, having a meaningful social impact. So people have been actually taking much more active, engagement. So active investing in, ESG means you actually find companies who are often best in class, companies who are environmentally conscious or socially conscious or has good governance. You invest in those companies. But the other way you can do it is actually engage in companies that have potential or have, meaningful size, but can actually change and become, better governance. So, the companies run better or they're more focused on environmental or social issues. So they actually can make an impact in society. So they get actively engaged. And in equities, you become a shareholder, you vote in the AGM, you engage the management, you change them, you help them to become better companies. In bonds, in fixed income, you lend them money, right? So similarly, as a lender, you have certain powers and you have certain influence over the management. So you're trying to influence them to do better. So I think, ESG is a very, very broad space, ill-defined. It's very difficult to define it. But basically, if you're trying to do good and do well at the same time, meaning that you're trying to change the world for better and you're investing for good returns, and you want to marry the two, that's what ESG investing is all about. The other side is actually charitable giving, just giving money to help, a good cause. Yeah. But you don't expect anything in return, right?
Yeah.
And then traditional investing is just focused on return. It doesn't matter how you generate the returns. You can invest in, all the evils and porn and everything and marijuana and make money no matter what. That's the other two extreme. But in the middle is trying to do good and trying to do well at the same time. So it's about returns and it's about doing good.
Yeah. So that sounds amazing, right? It sounds well and good, you know, and you invest in a good social cause, and you buy companies or you buy funds that pick companies that are doing good stuff and, align with your beliefs and all those kind of stuff. But, when you buy things in the secondary markets, in the stock market or in the bond market, the money does not actually directly flow into these companies, right? And as a retail investor, it's so small. My impact is so small. How do I then, really go beyond like, that as a like a marketing thing, like really having that impact. Just kind of help us paint that picture of like, if I invest in an ESG strategy, how my work translates into like the real impact.
Yeah, I mean, it's tough. It's tough to really feel it immediately. But I guess this is a really long-term trend, and we're at the very early stages of this change. I think, in the 90s, as I said, early like forms of this investment was really about, sieving out the bad companies and trying to invest in the good companies, but it didn't really make a difference at all. Volkswagen, the environmental calamity that they caused, or ExxonMobil, it didn't make a difference, right? So I get it. And it's for the retail investor, especially when you're buying companies directly, you're not going to have any kind of influence or any kind of an impact.
Yeah.
And that's why I think collective investment schemes, that's what the original name, official financial name is for a fund, is to collect and pool funds together and invest for a good cause. And so when people direct their retail investment money from single stocks or just regular funds into ESG funds, what you're effectively doing is pooling everybody's money and, making an impact because you're going to be bigger. So those, fund managers, and, we work with 5, 6, 7 fund managers who are the global leaders in this. They've been doing this for decades when nobody really took notice, when they couldn't gather any money from anybody, and they were like struggling. They were startups, right? And companies like Mirova, or in France and Boston, there's companies like Robeco, which is a Dutch company, #1 rated sustainable investing company, but no one's heard of it in Singapore. But Indawus finally brought it into Singapore, so another marketing pitch for us. But basically, these kind of guys exist, and they're actually making the cutting edge kind of innovation in this space. And what they're saying is that, hey, if you pool money, and these guys now have billions, if not tens of billions, and the companies are taking notice. And I think the big sea change happened last year, with COVID, with social issues in the US, globally, inequality, everything. Companies are much more aware that people want to, make a difference. And they're voting with their money. You see all the Reddit and, the US GameStop, what do you call it?
Like Wall Street bets.
Wall Street bets and all that, these things are stonks, these things actually are making an impact. And, I think the companies are taking notice. The fund management companies are taking notice, and that's a good thing. And it will take time to really make a meaningful impact, but it's driving companies to change their policies on how they look at climate and what their impact is on the climate, how they take care of their stakeholders. So not just their financial shareholders, but stakeholders, like people, their own employees, their welfare, the supply chain, their, outsourced partner companies, how are they treating them, the environmental impact of their manufacturing or primary, excavation of resources. All of these things are being taken into account, and they're really making progress here. And we just want to push them a little bit, nudge them even further along this line by voting with our money. And that's what retail investors effectively are doing. And it's perfectly fine if you say, hey, I don't care about this. ESG is not for me. I just want to make money. That's fine. Everyone's different, as I said. And some people are going to resonate with this and say, hey, I'm a millennial. I want to be, purpose-driven.
Tagging millennials again. Hello, millennials do more than social-driven stuff.
But you know what? It is interesting because I have Gen Z kids. I'm what do you call it? I'm older. Let's just say I'm older.
Okay.
I'm not going to classify myself. I'm not a millennial. But we did a survey of 1,000+ people on this ESG and sustainable investing. It was funny. Millennials are the most purpose-driven.
Really?
They are the most interested.
Well, guys, good stuff. Hashtag
good
woke.
Stuff, man. I love millennials. I mean, they're actually force for good, force for change. They're actually putting their, actions into, words into action. They're voting with their money now, and they're getting more and more of it. The millennials are going to be, either handed down or earning a big piece of the global wealth. So they're going to vote with their money. And it's important how they vote. And I think they're going to vote in the right way. So I'm really encouraged by the survey and what's happening. Yeah.
That's pretty cool.
It's super cool.
Shout out to millennials.
Yeah, I love.
So then, what are some of these major themes in the ESG space then? You know, so many things that millennials are concerned about, and fundamentally we have to pick certain sectors, right? And all those kind of stuff. So what are some major sectors, that you're seeing, that is interesting in the ESG space?
Yeah, so I think there's two big buckets. One is thematic, and then there's this core, ESG. So when I say core ESG, is the main pillars of environmental, social, and governance. Thematic is like, fluffy stuff like, water, or robotics, or, renewable energy, but it's ill-defined, meaning that, random companies go into this renewable bucket. Water, I don't know, let's not bring up HyFlux, but it's water, but it's not really right making a difference. They actually ruined a lot of people's lives, for example, right? It's having that holistic view of not just playing a theme or the flavor of the month, but really delving into how companies and these investors are looking at implementing E and the S and the G. Now everybody right now is focused on E. That's what COVID did. That's what people are more familiar with. Global warming, all of these things. So in our survey as well, 93% plus of people said they resonate with environmental issues. 93%, amazing. This is like everybody from 20-year-olds to 80-year-olds.
Bernie Sanders.
Yeah, but
yeah.
So that environmental is definitely key. Historically, the way ESG investors have focused on is governance. Right, proxy voting, are they doing the right thing? Are they siphoning money? Governance was really important. So we shifted to environment. I think the next wave, and many people are already talking about it, is social because of the things happening in the US. Income inequality, social issues are coming to the fore. Ethnic diversity, gender diversity, all these things I think are things that are becoming much more relevant and important to people. So how do we implement social? It's difficult. So you have to come up with the right criteria.
What are some of these criteria then? Exactly like what you point out, right? In the thematic stuff, is like big buckets and random things just go into the theme. But then if we go into, let's say, environment, what are some core matrices that, funds look at? To determine that, this company is actually good and core and, can be part of our core, like, fund based on environmental factors.
Yes. So I think that increasingly we're seeing a better definition. They call this like difficult word taxonomy, which is defining, things.
What metrics to use, right?
What metrics to use to measure, progress and to rank these companies or score companies. That's really important. And there's been tremendous progress. One of the, major initiatives came from the UN. So PRI is the Principles of Responsible Investing. More than 3,000 financial companies, including asset managers and pension funds and investors, have become signatories, and combined they manage over $100 trillion of assets.
Wow.
It's a bit of a fad because if you're not a UNPRI signatory, then you're like, you're not kosher. You're not really, doing
You're not
right.
kosher.
So everybody is a signatory, but they have a ranking now. So fund managers are ranked A+, A. All of our fund managers are ranked A or A+. Most of them A+. And then they look at how they, measure and, what are the criteria for investing. And environment is much more well-defined because, it's carbon emissions, it's, what kind of, water pollutions that you're, causing from your manufacturing sites. All these things are much more measurable. So environmental measures, I think, are much more advanced. But the social, as we discussed, social is much more fluffy. So I think that one's going to be much more difficult. But the most basic ones, things like how you treat your employees, gender diversity in the board or in your employment. Like we have more than half our board as females. If you include the board observers, it's more than 70%. That should matter, right? I did a webinar yesterday with Mirova and Schroders from London and Boston dialing in to talk about our equity strategy. And Natalie Wallace, who's the head of ESG strategy for Mirova in the US and Boston, she was previously the head of strategy for State Street Global Advisors, which is one of the biggest ETF providers, right? SPDR ETFs. And she was saying that, hey, I can't join your webinar unless you have 50% female speakers. And I was like, wow. But that's good. Definitely. We already had 2 each, so it was perfect for us. But she said that, and I was like, yeah, I mean, you actually need to be intentional about this. You actually need to say, okay, this is what we need to do. And, not joining webinars if women are not represented properly. In the US, like if ethnic minorities are not represented properly, Stop Asian Hate right now. Asian Americans are being beaten up in the street. It's ridiculous, right? In this day and age, in an advanced nation like that, these things are happening. So I think we definitely have to have a clear definition of what these criteria are and really hold people accountable to it.
Yeah. So all that being said, good and well, and all the interesting lovey-dovey stuff,
what you're gonna say.
Right? But are we gonna make money out of this? Right? Are we gonna beat the market out of this? Right?
All about the returns.
All about the returns, right? That's why we're tuning in here today, right?
Yeah,
so are we gonna run beyond the market in that sense? Right?
I'm worried because we had an amazing return in the past 12, 18 months. All the ESG strategies blew the lights out. All these thematic guys blew the lights out. They were up like 20, 30% when the market was up like, 10, 13, 15%, right? So it's done well. And, I once again, I'm going to go back to that mantra that I'm not going to try to predict the future because no one can, right? And so it's not about, whether they're going to continue to do well or not, because no one knows. I can tell you something and try to sell you something, but it might not. So I'm not going to try to predict and say that these things are going to be, better performing than your standard market beta, passive strategies. But what I can say is that I think the world is changing. That in the past, ESG strategies did not necessarily give you better returns, especially in public markets. In the private markets, all the studies show that actually it does better. And more recent studies seem to suggest that there is a positive correlation between higher ESG scoring companies and their returns in financial markets. So the studies, and I haven't looked at all the studies, but if you look at the fund managers and all the studies, academic papers, they tend to agree that it is improving. The big question is what's going to happen in the future.
Yeah.
And really, if you think logically and just go back down to the basics, right? These are companies that are going to be more kinder to their employees. So you're going to have better retention. Employees that are happier, who are better taken care of, who are going to have, more loyalty to the company, who are going to be working more efficiently, who are going to come up with more creative ideas. And, they work at shops where customers come in and, the customer service people are going to be happier and treating their customers better. So the customer gets a better experience. The manufacturing is cleaner, is safer. They're using material that's better for our skin and for our health. We're going to choose those products that are going to be healthier and better for us and for our children. So isn't it logical to think that these companies who are going to be more environmentally conscious, these companies who take care of their employees better, who are going to produce products and services that are better and more joyful and a better experience for our customers, aren't those companies going to win in the end, right? So if you think from that logic, I think it's very logical to think that if we invest in these companies, and some of them is bubblish, some of these are tech companies, like that did really well during COVID. So COVID beneficiaries and these guys. So maybe it will come back a little bit, but really long term, if you stretch out to 5-10 years, predicting 1 month, 1 day, is
Makes
impossible.
No sense, yeah.
Doesn't make any sense. Yeah. It's easier to look at the long-term trends and say, okay, over 5 years or 10 years, the trend of ESG, if we pick those companies that are doing those things, is it going to be better for our returns or worse? I think it's going to be better. Okay. So that's my bet. And that's why ESG investing is important. But the other thing is that if you hold values and you think these things are important, you don't have to necessarily sacrifice returns. So is it going to be a drag on returns is the first question, and it probably isn't. You can at least meet market returns. And if you're lucky, and if these trends play out, then you'll do better than the market returns. So why don't you do good and do well in terms of returns anyway?
Okay, so the base understanding is the market is already pricing a little bit of extra stuff in this space.
You put words in my mouth. I didn't say that.
Okay. But
no. Yeah.
But at least what I'm hearing is,
yeah.
The market has outperformed a little bit, in terms of ESG versus the broad beta market, right? Yeah. So it's doing better. And some of these composites may be a little bit in the bubblish space based on what you're saying, but you believe that the underlying businesses will catch up with that kind of price growth, because of all the good things that they're doing and you believe that the broader market wants these kind of stuff, better, better quality stuff, better service, more, better socially, products. Better product and all this kind of stuff. So that's the base
captures
case.
The imagination of consumers in terms of, doing good with their money, right?
Okay, good stuff. So that's the base idea.
I think what's important though is that, look, ESG investing is a very active strategy. So I think that's what something people. Yeah, you were okay. Okay.
Yeah. How active do we rotate through these kind of companies? Because from a composite level, are we going for like market weightage, or are we going for ESG score weightage? And how does that work then in this space? Yeah.
So I think it's really difficult as an individual investor to do this well. Because, well, in our survey, again, we asked them, a lot of people are interested, 90-something% in these issues. They want to allocate money. They said anything between 10 to 50%, mostly in that range. And the average was maybe 20-30%, which is a significant allocation, right? But the two problems exist. One is that they don't feel that they know enough, or they don't feel they are comfortable, right? Yeah. The second thing is that even if they are and they're looking for stuff, they can't find anything.
Yeah. I mean, there's so much extra work that you need to do to understand this.
Precisely, yeah. And even if you want to, there's no like one exposure or one place where you can just buy a strategy. So that's what we try to solve it in Endowus, is to build a portfolio that's ready-made. We've already done all the hard work of looking at all the hundreds of funds out there globally. Most of them not even available here, so we had to bring it into Singapore. It took us like 6-9 months to actually execute. And finally, we have a portfolio across equities and fixed income. First in Singapore. We have some 100% equity things, not really ESG, but purportedly it is. There's like passive ETF strategies, but it's really pretty crap. But equities, fixed income, best-in-class funds, exposure to broad sustainability, including climate and every sector. Building that portfolio was tough, but we got it out, and it's available to retail investors, most importantly. This space was mostly done by institutional investors like sovereign wealth funds. GIC would do this, but retail investors is impossible. But we made this possible. And the reason we did that was because we want people to have that choice, right? We don't want everybody to go into ESG. We don't want everybody to put 100% of their assets in ESG. But if they want to put 20, 30, 50%, we should give them that choice. So I think that was the first thing. What is the right number? I don't know. Everybody's different. I'm willing to sacrifice a little bit of return to do good. I can allocate 100% of my portfolio. Fine. But I'm a little risky. I'm really like you. I want returns. Then then I'm going to allocate maybe 10%. And anything in between is fine, I think. But the average seems to be 20, 30% of your allocation. And the other thing is that as an active strategy, you're going to be very concentrated. So if you look at the traditional like investment kind of philosophies, broad diversification is a good thing for us, right? Especially as individual investors. Being too concentrated is probably higher risk. So if you're able to stomach that risk and you're okay with it, and you can, you want to do that, that's fine as well. But if you want diversification, then I would say that the 20 to 30% or below allocation is right. And then you keep most of your assets still in that broad, passive, globally diversified kind of portfolio, which is the core portfolios. Even within Endowus, we have core portfolios, and then we have the ESG portfolio.
So walk me through a little bit about the active process. How is the ESG fund active in that sense?
Okay.
Like what do we do? How does it? How do you choose to circulate around and change your stocks, and how does that work?
Okay, so there's passive versus active. There's two layers. One is at the asset allocation level. Our asset allocation is actually passive and strategic. So we don't like move things around because the economy is doing well or not doing well. Random factors don't drive our asset allocation. So we try to keep it as broadly diversified and global, sectorally neutral if we can, as much as possible. So our core portfolios are like that. Our ESG portfolios are similarly strategically passive asset allocation. At the individual stock level, securities level, that's where the active selection kicks in. And in ESG, by definition, you're active in terms of selection because you've already taken out the bad companies. Negative selection already means you're active. So you can create a negative index and be passive to that index, but that index itself is an active decision. You see what I mean?
Yeah, I get what you're saying.
So passive is being used around in various different ways and used in a wrong way. But, I think ESG is all active. There's no passive, truly passive, right? That's the first thing. Secondly, if you're going to be active, then how do you implement that active strategy was your specific question. As I said, when you take out the negatives, that's an active first step. The second step is among those left, which ones are the best companies, and you want to allocate to those best environmental score company, social company, or governance company, then you want to do that. And some would focus only on social, say, I want to be a socially responsible investor, I want a social impact strategy, then you're going to focus and overweight the social factors and social scores. If you're an environmental fund or a climate fund, you're going to focus primarily on the environmental and climate. So again, the sector and which ones you actively allocate to is another active decision.
Yeah.
And then within that, you're going to have a scoring mechanism.
Yeah.
Right. So all the criteria that I mentioned is, the carbon footprint, water, all the air pollution, all the things that you look at. Each company does it differently. And then you would allocate a certain portion into each of those criteria. You score it, you analyze, you evaluate, you score, and then you allocate, you size the bets in that way. Now, the final piece is there's guys who are active in selecting stocks, and then there are guys who are active in the managing of the companies. So as I said, there are investors who actively engage the companies and try to improve them. They think by doing that, you can generate alpha.
So you're activist.
You're an activist investor, precisely. Yeah. You're activist, active investor. So that there's gradations and different levels of activeness. And different ways in which you can implement your active strategies. And we have the whole spectrum within our portfolios. Yeah.
Okay, so most of the ESG funds, they choose the companies based on the ESG score. Is that what I'm getting? Right. So it does not matter the underlying market cap or the business. It's really just based on the score.
Yeah.
And then they will choose their composite from there.
The ones we like, we prefer if they use their own in-house proprietary measures to score that. So using like MSCI or these like Sustainalytics, broad like third-party indexes, it's not as sophisticated, it's not as, well done. And those ETFs that use these kind of passive third-party strategies are pretty poor in their track record. And they don't even vote even, they're not very active in involving and improving.
They're just joining the hype.
They just, it's like call it greenwashing or, it's fad, following the fad. So, people buy these ETFs, but a lot of them I just feel are not up to scratch. And so we've chosen only those that have active in-house proprietary research, an actual team that does ESG and know how to do it. They don't just talk about it and have random investors who have no track record in ESG, picking these companies. It's actually guys who are really, well-researched, documented, have a great like system in place, and they're scoring well and they're investing in those companies.
Okay.
Yeah.
And ESG as an investing theme, right? Like how long has it been around? What is the kind of track records that we're looking at? Or is it just like a very young thing that's just kind of recently caught on fire? Because you did say that there are all these funds that have set up and nobody knows them.
Yeah.
Right. So like how has the growth been, and do they have that track record to give retail investors that confidence? Right? Because we don't want it to be like, based on 1 year, 2 year growth, and that's it, right?
Yeah. And this is the biggest problem I have with the current fund distribution, like fund platforms and stuff. They give you 1 year performance, 3 year performance, because that's all that matters, right? I just don't like people focusing on the short-term performance. And that's why we try not to highlight, even though it's easier to sell that way, right?
Yeah, for sure.
1 year performance, great, you should buy it.
People
jump on it.
And then,
and then they lose out if it's not sustained. The returns are not sustained. But
pun intended.
Pun intended. So we don't want to focus on those things. So we're looking at our own measure of like due diligence on these fund managers to make sure that they're doing it in the right way. So this ESG space has been around since the 90s, I think. But
really?
a lot of it was this kind of negative screening, simple stuff, which didn't really work. It actually, long-term ESG passive index strategies have underperformed the market.
Okay.
So
not the ones we want.
Not the ones we want to touch. So forget those. They started early, but they're not very good. Okay, then in the 2000s and more recently, you've seen these kind of companies like Mirova and Robeco, all these companies appear, and they're not like humongous companies, but they do it really well. And so those guys could have track records up to, 5, 7, 10, plus years. But they were at a smaller size. So it's important to understand, how they perform when they're small, how they perform when they're bigger, is it sustainable?
Can you scale up, right?
Can you scale up? So that's important to look at. But there are guys who've been around with good track record. And then there's a bunch who started in the past 1 year, 2 years, 3 years. And every fund manager that we meet are saying, okay, we're going to integrate ESG, which means that we're going to talk about ESG in our normal investing process, and it doesn't really make that much of a difference. And then there are guys who are actually proprietary, ESG, systematic investment processes, really taking it to the next level. Those are the guys that I'm most interested in, because those are the guys who I think will differentiate themselves, because those guys will pick the right companies, and those companies, as I said, I believe will be the successors of the future. And so it's really important as active managers to really have a very high standard of picking those stocks.
Yeah, that's great. And have you looked into a little bit of the green bond kind of thing recently?
Yeah.
Right? Because like exactly what you said, it's very difficult to do your own work, right?
Yes.
Because it's a whole different thing. You need a whole team to look at these stuff, right?
Yeah.
But you sort of see some companies or some governments, doing these kind of one-off, offering of like green bonds. And so what are your thoughts on that?
Yeah, I think they're wonderful initiatives. And
Initiatives,
yeah.
right? Stirring the market, but not really there. Is that what I'm getting?
No, I think it's making an impact. It's growing. So green bonds as an asset class is growing. I think is really good.
So what is green bonds actually? Yeah.
Green bonds are just bonds that are issued with a very specific purpose, environmental or climate purpose, reducing carbon footprint or reversing the climate warming, issued by governments or corporates with very specific purposes. Like, for example, let's say you are building a solar farm, in China, and the company want to finance that, solar farm, want to issue a bond, then that would be classified as a green bond. And so it's actually a bond, but it's for a very green purpose. It's very simple.
Yeah.
So that's what green bonds are. Yeah. And governments who have public infrastructure initiatives or other kind of, investment initiatives where they want to finance it with bonds can, claim to be a green bond. Now there's, associations in Europe especially that, classify as green bonds. So you need certification to be a green bond issuer or classify that bond as a green bond. So we need to go through that process. Now, it's a growing space. It's just like any other bond though. You have to look at the project.
Is there like an ESG premium on that? Like,
it depends.
Like, do you see a trend where similar kind of like infrastructure development, but one with like green, and then there's a premium on that? Is there something like that? You know what I mean?
I know what you mean. I know what you mean. But it's difficult to answer because you know what? It's actually demand and supply, right? Just like any other pricing, it's demand and supply. So if it's a hot project that's going to have good IRR, good returns, and it's by a very trustworthy, high quality company that everyone knows, they're going to flock to it, right?
Yeah.
So they're going to put the price up, bid up the price, which means that the interest rate goes down, right?
The yield comes down.
Comes down, which is not good for investors because it's less yield.
Yeah.
But if it's like a little bit of a risky project from a slightly risky company, then they're gonna have to pay up 13%, 10% for that project. And it's a good deal if it stays solvent and the project makes money. And so it depends how you look at it. Is it a good deal from a yield perspective? Is it a good deal from a credit perspective?
Yeah.
It's so much easier to value equity companies, stocks, right?
Yeah.
Because you're just buying the company.
Yeah.
And you can make a bet on the overall company.
Yeah.
For bonds, it actually depends on the issuer, depends on the project, depends on the
market,
timing,
a lot of stuff.
interest rate, where interest rates are, so many different, and liquidity suddenly dries up in March of 2020, and it's a great project, but no one wants to buy the bond because they don't have any money. Then the yield's going to spike up. So a lot of things, a lot of moving parts when it comes to fixed income. Yeah.
No simple answer.
No simple answer to it. Sorry,
Clearly, no simple premium recognition. Nothing there.
Equities is much easier. Yeah. Because if it's a good company, it's a good company and should be bid up.
Yeah. So if we were to subscribe to this whole ESG investing methodology and this idea, right? Is there like a platform that we can go and see the impact? Is there like, are there bodies or websites or some place that we can go and see like, oh, okay, this thing has impacted so and so, so and so?
Yeah. So it's two things. One is measurement, and second thing is disclosure.
Yeah.
Right. Both are really difficult. First of all, measuring your direct impact is very difficult. So on our Endowus website, when we launched the ESG portfolio, Sheng Shi, actually, who was here earlier, our personal finance lead, he designed the ESG calculator with our investment team. And so, every time you invest $1,000 in the ESG portfolio, this is how much carbon emission, it's like 2 trips from, I don't know, Tanjong Pagar to Phuket or whatever
try
it is.
to,
Trying
make
to
it
crystallize
more,
it. Yeah, so you can go on the endowus.com website and see that ESG calculator and play around with it. So a lot of people do that kind of stuff. So people can understand what your actual impact is.
Yeah.
It's difficult to measure. The easiest one is environmental, right? The social and governance is very difficult to measure. But also, it's on the company to disclose a lot of information. There's no consistency in the disclosure.
Yeah.
And that's why regulation is important. So governments and regulators have to step in and say, hey, listed companies need to report on these metrics that are important in our view. So Europe is at the forefront of this. So they've just announced a recent initiative, and regulations are changing there where you need to improve disclosure, have more standardized disclosures. So that's great, and the US and Asia hopefully will follow. And as disclosure improves, the measurement will also improve, I think. So we're early days, but I think it's improving overall. And hopefully we can repackage it like we did with our ESG calculator so people can understand it better.
Nice. Cool stuff. So then if someone wants to do that, is there like a place where they can go and check it out, more information, and where should we go to look for?
Just if you type sustainable investing, like amazing, like massive literature places. So fund managers, Endowus, we have what's called Endowus Insights. So when we began the company for over a year, we didn't have any commercial business. We just wrote on investing. It was like a blog. And so people thought we were bloggers before we launched the service. And you know what? SGX nominated us for Orb Award for financial journalism, financial literacy. We had no idea. Like they suddenly said, you're nominated. We go, what? Us? We're not even journalists. We're not even bloggers. We're launching a service, guys. But that's what we got known for in Endowus Insights. And back then it was called The Know. And so I think financial literacy, improving financial literacy, helping, with financial education. What you do, Reggie, is amazing. Fantastic. Love it. And I think it really makes a difference in people's lives. And it's a responsibility for people in media, but it's a responsibility for us as service providers to help educate our client base to be more knowledgeable so that they can make informed decisions about where they place their money. And hopefully that will lead to better outcomes. There's also a place to be played by regulators, the MAS, and the industry associations to also contribute, and they do a lot, admittedly, to improve that space as well. So it's a collaborative exercise, and we'll do our part. But if you type sustainability, there's like tons of resources. So it depends on what your interest is. Are you more academic? Then you can look at academic papers on sustainable research, investing. If you want really simple stuff, just look at Investopedia or financial blogs who talk about sustainable investing, and just read the light stuff. In between, we have Endowus, we have the financial fund management companies. I wouldn't go to brokers or banks. They're really normally quite bad. Sorry, I keep bashing banks today. Not intentional, but banks do better.
There's a reason why you left.
There's a reason why I left. That's right.
Nice.
But they need to do better. But the fund management companies, because they're the guys who actually do the investing. They're the professional managers. They're the professional investors. So they're the practitioners, right?
So all the reports are there.
Precisely,
right?
yeah. Nice. If you want to learn about how doctors operate, you don't go to an academic or read some
Just hang out with the doctor.
You ask the doctor how it's done, right? So if you want to learn about investing, ask the investors. And so fund managers have a lot of resources, and I would recommend Mirova, Robeco, Schroders, Aberdeen, Standard Life, names that we're very familiar with, even BlackRock or other big companies. They have a lot of resources on sustainable investing, and they're putting it up at the start of their web pages and landing pages these days,
Yeah, I know.
because it's,
it's
the fad,
hot thing.
right?
It's a hot thing.
It's the hot thing. So you won't have any trouble finding these resources. It'll be easy to find.
Awesome. Cool stuff. Thanks for coming on. We had a great time. Appreciate it.
Thank you,
Good stuff.
Reggie.
you learned something useful today and truly appreciate that you took time off to better your life with the Financial Coconut. Knowledge is that much more powerful and interesting when shared, debated, and discussed. Join our community Telegram group, follow us on our socials, sign up for our weekly newsletter. Everything is in the description below. And if you love us and want to help us grow, definitely share the podcast with your friends and on your socials. Also, sign up our members backend for more investment-related content, live discussions, curated content, and most importantly, your commitment to us is a step forward for us to continue creating great content focused on you rather than advertisers. For more information, check out thefinancialcoconut.com. With that, have a great day ahead, stay tuned next week, and always remember, personal finance can be chill, clear, sustainable for all.
There's 3 questions for you that we ask everybody. And the first question is, what is a core life principle that you hold close to?
Oh man, that's tough.
Have 3 kids.
I have, no. Everybody's different again. So more broadly, life principles, I'm all about helping others. I think it gives me the most satisfaction. I think it really brings meaning and purpose to my life. I think they win, I win, right? And, if I do that, then sometimes, being selfish, helping others, sometimes other people can help me too. So help or love, you can place different words into it, but helping others, loving others is what I'm all about.
Cool stuff. And next question, what is a personal finance advice that you feel needs to be further propagated?
Endow us. You need to use the Endow's platform. No, just kidding. I'm just kidding. Yeah. Well, dude, we're a young brand and people don't know us as well, but they should know and use it because it's easier, it's better, it's cheaper. It's
all the plug.
No, just kidding. I know you're gonna cut this out, so it's okay. I'm just joking with you. Yeah. So, sorry, the investment. Okay. Look, if you have the time and you want to learn about investing, do it, right? So invest. Don't just think about it. Invest in a stock, even a simple company like Apple or Tesla, Amazon, or closer to home, Singtel. Invest and see how it goes. Because unless you put your money where your mouth is, you're not going to spend the time to learn and be better at investing, right? So that's the first thing is just go and try it. But everybody's different. So unless you're a professional investor, don't try to do everything yourself. Use the professionals to your advantage. So that's the second thing. Third one is cost, right? Look at cost. You look at, when you buy a green tea, which I have a bottle of green tea, you look at the prices. You don't just buy any green tea. When you're buying a car, you compare prices, right? Yeah, and you shop around because the same car could be sold at different places. Maybe parallel importers are cheaper. When it comes to investing, same thing. Look at the cost. The same fund is sold through DBS, through Fund Supermart, and through Endow Us, and through, a broker. They're all different. You got to look at the cost because 1% difference in cost compounded over 30 years is a 250% difference in return.
Yeah.
Just save 1% and do that over 30 years and your life will change. So cost. You got to look at cost.
Nice. Good stuff. Love that. And last question, which part of your life are you giving additional focus on now?
Relationships is what I'm all about, right? Because at work, at home, it's all about relationships. And so I want to invest my time, my money, my energy in relationships. So, I left the company, Morgan Stanley, after a long career. I had no more income. I prayed to God that, look, at least give me enough money so that I can buy people lunch. I don't want to skimp on, lunch or not being able to pay for lunches for other people, right? So, and because that's important to me, right? I want to build relationships. I want to maintain relationships. I want to help people. And so relationships is all of what I'm all about. And it doesn't matter where, work, home, all of my relationships are important. And this relationship, Reggie, is important.
Cool stuff. Oh.
Thanks, man.
Fist bump.
Fist bump.
Thank you.